When it comes to equities and fixed income, both markets historically have had more periods of positive returns than periods of negative returns. Both individual and large institutional investors have an aversion to holding too much cash and reserves. While holding cash can be a positive in terms of protecting the portfolio in a down market, and it might be necessary in order to honor redemptions, it is a major performance drag if the market should continue to advance as it has for much of recent history. Cash does give you reserves to invest in any potential bargains should the market decline. But in a bull market, cash is trash, as the saying goes. So how does a pension plan or a money manager combat cash drag? By using a technique called cash equitization that allows them to put excess cash to work. The primary tool for implementing a cash equitization strategy is stock index futures contracts. Their exceptional liquidity, low transaction costs, as well as a near 24-hour availability makes them an excellent vehicle for equitizing cash. Let's look at an example. A portfolio manager that runs an S&P 500 index mutual fund finds out that he has $1.2 million to invest. The portfolio manager receives this information around 2 p.m. Central Time, an hour before the market closes. Since his performance is benchmarked against the S&P 500, it's important for the money to be fully invested as soon as possible. Otherwise, he risks underperforming the benchmark. In this case, cash equitization is a strategy whereby the portfolio manager invests his cash in an instrument that will track his S&P 500 benchmark. The portfolio manager could equitize the $1.2 million by using E-mini S&P 500 futures contracts. Assuming an E-mini S&P 500 price of $2,400, the notional value for a single contract would be about $120,000. So the manager can buy 10 futures contracts to equitize the entire $1,200,000 in cash. Due to capital efficiencies in futures, the investor only needs to post performance bond margin. Since the S&P 500 futures correlate extremely highly with the underlying index, he now has fully invested the cash and will not have to worry about tracking error relative to his S&P 500 benchmark. There you have it, cash equitization, a commonly used strategy to pension funds, endowments, fixed income managers, and other money managers to minimize the effects of cash drag.